Hello and welcome to this MithrilMoney course on Securities Investment 101. This is the course introduction in which I'm going to answer sort of three basic questions. Who would want to watch this series of videos? Second thing is what is a basic security? And the third thing is what are the course contents going to be? So, Securities Investment 101. So who's going to want to take a look at this this course? Well, it's going to be for two groups. The first group is people who want to know something about securities from a kind of just interest level or an academic level. They want to know what's going on in stock markets and what are shares, what are bonds, what's foreign exchange. Probably the much larger group, though, is anyone who has a securities investment exam which they want to get into, and they just want some kind of boost or refresher or update on the kinds of things they're going to need for securities investment. Now, I don't know how many videos this is going to be. I'm just going to keep going in the sort of style of Khan Academy until I've finished, essentially. So, how many courses? How many videos? Well, let's just go along and we'll finish this one off. Each one will be fairly short. I don't want to eat too much of your time up on a daily basis. But as we go along, you know, it'll build up into quite hopefully a large library of things. So what's the second basic question? I'd say the second basic question is going to be along the lines of what is a security, so that we know that we're in the right place for spending some time. Now, a basic security is a legal secure claim. It's essentially it turns into being a piece of paper. Let me just grab this and move it up the screen a bit. So, shrink that a bit as well. So, if you think of a company, there's a company there. What we do is, who controls the company? Well, what we do is we divide a company up into various slices. I'm going to try to do 16 slices. Can I do 16? Ooh. And each slice of control has a piece of paper associated with it, which is the legal secure claim to control. So this piece of paper here represents 1/16. I know that's a big fat 16th, but hopefully you get the idea. That represents 1/16 of the control of the company. So you get a 16th of the voting power, a 16th of the dividends, and a 16th of the losses, unfortunately, although most companies in the world tend to have state regulations protecting them through limited loss rights. So you pay for that piece of control, or you get given it on the company's founding, but usually you'll buy that piece of control. If you want to cash in, it does really well. It goes from $1 to $2, and you want to make 100% profit. You go to the company and say, oh, I'll give you that share back if you give me $2. And they say, no, we're quite happy with you having the piece of paper. So you sell it to someone else. So that other person now has a legal secure claim to the control of 1/16 of the organisation. So that's a basic share or stock. Now, again, on this course, we're going to cover things which are going to be useful for people around the world. I'll typically use English notation because that's the words, because that's the stuff I know best. But hopefully this course will be applicable to anyone taking a securities investment exam in Australia, New Zealand, Canada, United States, Hong Kong, Singapore, the UAE, anywhere around the world. And I'll try to avoid any kind of country-specific regulation, although I will tend to use English British terms because that's what I know best. Now let's get on to the other kind of major kind of security. Now the other kind of major kind of security is a bond. So what is a bond? Okay, well, where does a bond come from? Here's the company again. And let's say they want to buy an aeroplane. I want to start a new airline or a new division. I'm going to buy an Airbus. Let's say it's going to cost $100 million. So the company's divided up into various areas of control, represented by paper shares down here. And so the company's board of directors, who are employees, They might hold shares, but let's just pretend that they're employees for the moment. There's the chairman, the CEO, finance officer, etc. They go to the current shareholders and say, oh, can you give us $100 million and buy some extra shares that we're going to print in a corporate action? And the shareholders say, no, go away. What will then happen is the company will issue a bond, which will be a pool of capital debt, or at least they'll be asking the market to fill that bond up with some capital. And there'll be various people over here who say, yeah, that looks like a good deal. It's a well-run company. I think their idea for an airline is good. So what we'll do is, let's say that's $100 million again. So we just got at the top there. Okay, and they're going to sell it in $100 lumps, this debt. This person says, oh, that's a good idea. So I'll buy one of these. I'll give them some money. Now, it doesn't need to be 100. It could be 99. It could be 98. It could be 105. It could be any amount. But so imagine they give them some money. That piece of paper will represent 1/1,000,000th of that debt. And if hopefully another 999,000 people put forward, something close to $100, the company now has the money to buy the aeroplane. That aeroplane will then go backwards and forwards between London and Singapore on a daily basis. And as it does so, it will be generating tickets, sale revenues, and it'll be generating cargo sale revenues. And once we've taken off all the costs, what's left will form two things. It will form profits for the company. So there'll be profits, costs, and interest payments to all of these people from that capital that was loaned. So interest on the loaned money. Let's not worry about these two bottom people. Let's just worry about this, our little person here. So they'll be getting interest, and that will generally be specified. It might be 7.5% on the original issue of the capital. So they're going to get $7.50 a year for their $100 worth of debt that the company has issued to buy the plane. And then after a specified term, let's say this plane's going to last 20 years. So they say after 20 years, whoever's holding that piece of paper will get back $100. Oops, $100. Now, if you decide to go off, get your money back early, you can offer the bond back to the company and say, give me $100 early, and they'll say no, usually go away. And again, you can just sell that bond on to someone else, and that person then takes over that bit of debt. Now, they'll have a legal secure claim to interest payments, regular interest payments, and the $100 back. Whoever's holding the piece of paper after 20 years gets the $100 back. Now, why is it called a bond? Well, back in the good old days, Victorian times, the Olympics opening ceremony had lots of men, top hats. So I'm going to have somebody in a top hat. We'll go down to the stock exchange and say, I need £100. My word is my bond. And you'll say you'll be wearing a top hat as well. And you'll say, I'll give you £100, and then you both shake hands. And the guy on the right says, my word is my bond, that I will pay you £1 every month for the next year, and then give you the £100 back at the end of the year. My word is my bond. Fantastic. Similar sort of thing. Here's the weird thing. When you go to a bank, of course, and take out a bank loan, what you're actually doing is you're actually selling a bond. So if I go to the bank and borrow £100, they'll say, okay, Mr. Duncan, you can borrow £100, give us £5 back every 3 months, and at the end of the year give us back the £100. You are in fact selling the bank a bond, and you need to honour that. Now, of course, there's risk associated with these things. Obviously, risk associated with shares. Companies can crash and burn. There's a risk with these bonds. The company might go bust. Okay, company might go bust, and there's no more interest payments, and you're not going to get your money back. But you might have a security on the aeroplane. You might get the aeroplane if it still exists, and it will be up to the company to insure the aeroplane and maintain the aeroplane. And if the company goes bust, all the bondholders now own the plane. Okay, so that would be, you'd have additional security And we'll talk about that on the course, and sometimes you don't have the plane, sometimes you just don't get anything back. That'd be unsecured, but we'll talk about that during the course. Okay, what's the final kind of question we need to answer before we move into the proper course? What we're going to cover on the course itself then. So let me try and draw a nice mind map for you. So MithrilMoney, Securities Investment 101. What's the detail of what's on the course? Okay, first thing, asset classes. Assets are good things to be holding. So we're going to have asset classes. And we've talked about shares. That's the thing you can buy. We've talked about bonds. That's another thing you can buy. We'll also talk about a thing called depository receipts. And what they are is a way of wrapping up a group of shares. Let's say there's 5 shares over here in pounds that are worth what 1 share would be worth in the United States. Well, what we can do is we can create a piece of paper and essentially put those 5 British shares, which are in pounds, embed them inside this piece of paper and sell that for dollars. And now we're trading those 5 shares inside this basket. So it's like buying a box of wine. Let's make it 6. You know, you get 6 bottles of wine in a box, don't you? So there's 6 bottles of wine inside a box. So now you're not trading bottles of wine. You're now trading boxes of wine, priced typically in a different currency. And there's American depository receipts and global depository receipts, and we'll cover both. Now, according to my initial answer to the question, what is a security? FX isn't really a legal secure claim, but we'll cover it anyway. This is foreign exchange, and this is, you going to the airport with £100, you hand it over to the Travel-X person, say, can I have $150? And they say yes, take a small commission. And then hopefully you go to the United States, you don't spend any money, you come back, and then you hand over your $150 and get £200 back because the interest, the rates have changed between the two currencies. Brilliant, well done you. That would be an example of foreign exchange, only we'll talk about it in the kind of stock market sense on a much bigger scale. It kind of gets put with shares and bonds, but it's not desperately a security. It's a thing in its own right, but it gets lumped in. So we'll lump it into this course. Okay, we've got the idea of assets. Now we need to bring them into existence. So we'll have the idea of a Mercedes car. So we'll have a factory. And we'll have the idea of building a car in the factory. It's a nice Mercedes. How are we going to sell that car? Well, the first thing we'll do is we'll go to a primary market. So we'll cover that on the course. And we'll go to a fancy Mercedes dealer, Mercedes exchange. And a fancy car dealer anyway. Go to a fancy car dealer, brand new showroom, and buy a brand new car in there. First time it's ever been sold, it's never been on the road before. Fantastic. So that's the basic idea. Now in securities we have IPOs, initial public offerings, in which you do the same thing. Facebook starts off, they sell 1 billion shares at $1 each, create $1 billion worth of equity. They'll do it via an IPO. That'll be for shares, new company, or first time it's been taken out of private hands. And also we've got bond offerings, nothing to do with Daniel Craig and swimwear. This is where a company comes to the market and says, we'd like to build a Harry Potter theme park. We need $1 billion. We'll issue a bond. Who wants to give us somewhere near $1 billion, and we'll give you interest on that money for a specified period, and then we'll give you $1 billion back at the end. So that would be a bond offering. Also as well, sometimes a company, as it's going along, it sometimes needs a buffer. It needs more capital. It often issues more capital as share capital. It prints more shares and sells more shares. Now, this would be a corporate action. And you'll hear them called rights issues and bonus issues and scrip issues and all sorts of issues. But this is basically the creation of shares as the company's going along. Sometimes they buy the shares back. There'll be a share buyback corporate action, in which shares are destroyed. But we'll cover everything we need to cover in most securities exams on corporate actions. Now you've bought your new share from your IPO, your Facebook share. You want to sell it on. Where'd you do that? Well, buy your Mercedes or your car. Well, you sell it in the secondary markets, don't you? And this is where we do buying, selling, buying, selling, buying, selling. Think of your Mercedes. You sell it in Exchange and Mart or in a second-hand car dealer, and it goes round and round and round and round and round until either the car rusts or you buy a new car. In the secondary market case for stocks and shares, companies can go bust, their shares will disappear, or they can get taken over, and so the shares would disappear then. Same thing for bonds. Bonds will mature, come to an end, the money's paid back, the Harry Potter theme park is paid back, and we're done. So we'll talk about secondary markets, we'll talk about stock exchanges, we'll talk about market data, how much you're selling stuff for, we'll talk about, it's a pretty dull area, but we'll do our best, a thing called settlement. This is where there's two Victorians. We'll do a Victorian lady, a Victorian man, and he has some shares and she has some money. She agrees to give him her money, he agrees to give her his shares. They shake hands. There's two very rough hands, and then 3 days later his shares turn up in her broker's account and her money turns up in his broker's account. So there we go. Now, which shares to buy and sell? One of those two people made the wrong or the right decision, didn't they? One of them sold it when the market was going up and so on. So maybe both people did the right deal according to their needs. But what should we sell? What should we buy? What should we hold? Well, that's where we need some financial analysis. And here there's a book called Security Analysis by two guys called Dodd and Graham, filled with millions of ratios, price earnings ratios, earnings per share ratios, all sorts of ratios. And you can use these to screen and filter from all of your assets which ones to buy, which ones to sell, and which ones to hold. A final area we'll cover on the Securities Investment course 101 is we'll cover risk and reward. So we'll cover portfolio management, the fact that if you take lots and lots of risk, you might make lots and lots of money, but you also might lose everything. So if I put all my money in Bitcoin and it goes up 10 times and I sell them all, then I've made loads and loads of money. But if I put all my money in Bitcoin and Bitcoin crashes, I'll lose most of my money. So, or I can spread my investments around 100 different things. 10 things go up, 10 things go down, 80 things roughly the same. It's not very exciting, but it's much safer. That'd be called diversification, where I diversify my assets. But it's just, think about it, spreading stuff around. Sailor has a girl in every port. Or you put all your eggs in one basket. It's up to you. Anyway, we'll also talk about, as well as portfolio management, we'll talk about the fund types, whether to invest in a hedge fund or a pension fund or a unit trust fund or what kind of do-it-yourself. We'll talk about all that. Anyhow, I shall see you, if you're interested, in the next video. But just before I go, if you are interested in any private financial training services from MithrilMoney, mainly based at the moment in London and Singapore, please do contact us via the address either in the show notes or shown in the caption below. Okay, see you next time.